Right now, there are millions of really hardworking micro business owners, freelancers, and side hustlers out there who are they're accidentally bankrupting themselves.
And it's happening every single day.
It is. And here's the truly tragic part about it.
Mm.
It's not because their business model is flawed. It's not because they aren't making enough sales or because they lack the drive.
Right, they have the hustle.
Exactly.
Right.
They are failing because they're trying to track their daily hustle using an accounting language that was, well, designed for multinational conglomerates.
Which is a complete disaster.
It's a recipe for absolute disaster. I mean, imagine trying to use a system built for a massive multi-billion-dollar corporation just to sell bread and milk from your garage or to track those freelance graphic design gigs you do on the weekends.
It's the financial equivalent of trying to navigate your quiet suburban neighborhood using a map of the entire global oceanic current system.
Oh, wow. That is a great way to put it.
Right, because you have all this data, all this immense structural complexity, and yet you still have absolutely no idea how to just get to the end of your own street.
Yeah, you're just lost in a sea of data.
Exactly. And so people sit down at their kitchen tables, surrounded by this chaotic mess of bank statements, crumpled tax forms, and, fading grocery receipts, and they feel this overwhelming sense of guilt.
They really do. They assume they're just bad at math or that they're hopelessly disorganized.
But they aren't. They really aren't.
And that is the massive paradigm shift we are exploring today in this deep dive. You are not bad at math. You've just been handed the wrong dictionary.
Yes. The completely wrong dictionary.
So today we are diving deep into the South African household chart of accounts. And we're specifically focusing on the micro retail template.
Which is often associated with really accessible, simple systems like TurboCASH5.
Right, TurboCASH5. And this is a completely streamlined, logic-based accounting structure. It is a totally different beast than that intimidating, heavy corporate software you might have tried and probably abandoned in the past.
It really is a fundamental rethinking of how we approach personal and microbusiness finance. I mean, traditional accounting architecture was built from the ground up to serve auditors.
And shareholders, right?
Yeah, shareholders, massive regulatory bodies. But this framework, this one is built for real, messy, everyday life.
The stuff you and I actually deal with.
Exactly. It's designed for the reality of running a household or scaling a side hustle or operating an informal retail setup like a local spaza shop.
So our mission today is to completely demystify this for you. We're going to break down how you can start tracking your personal finances using a simple, stripped-down account structure.
No more terrifying accounting jargon.
None of it. We're going to show you the exact mechanics of keeping your business revenue strictly separated from your family's grocery money. Because, honestly, that is where most people trip up.
Oh, it's the #1 point of failure.
Right. And we will reveal how setting up this logic practically does your annual South African tax filing for you.
Which is just huge. It transforms tax season from this period of absolute existential dread into a calm, data-driven copy-and-paste exercise.
It's just copying and pasting. I love the sound of that.
It's true, because when you have an architecture that natively understands the difference between a business expense and, say, a personal lifestyle withdrawal, you gain this level of financial clarity that most people assume requires an expensive CPA.
Okay, let's unpack this from the very beginning. We really need to talk about the core problem that makes people just universally hate accounting.
The dreaded gap trap.
The gap trap, yes.
Right.
Financial experts always talk about this. What exactly is the gap trap, and why is it making everyday entrepreneurs so miserable?
Well, to understand the trap, you really have to look at what standard accounting software throws at you the very second you install it.
Right, the default settings.
Yeah, the default templates. The traditional accounting world is fiercely regulated by frameworks like GAAP, that's Generally Accepted Accounting Principles, or IFRS, the International Financial Reporting Standards.
Which sound very official and very intimidating.
And they are. Now, if you are running a publicly traded telecommunications company, GAAP is your absolute lifeline. It is what keeps the global markets stable.
Sure, because investors need to know the numbers are real.
Exactly. But here's the catch. Because software developers build their platforms for their biggest, most lucrative clients, those heavy multi-digit ledger accounts end up as the default templates in almost every app on the market.
So you log in to track your weekend plumbing jobs.
Yeah.
Just trying to see if you made a profit on a pipe repair. And suddenly the screen is demanding you categorize things into, like, deferred tax liabilities.
Or amortization of intangible
Oh my
assets.
gosh, amortization of intangible assets. What does a freelance plumber or a spaza shop owner even do when faced with a drop-down menu that says that?
They freeze. They just completely freeze up. They get intimidated.
I would too.
The clutter creates this immediate cognitive overload. I mean, if you are running your business from a smartphone app while you're literally standing behind a counter serving customers, you do not have the time or the mental bandwidth to parse through a 1,000-line corporate chart of accounts.
No, of course not. You've got people waiting in line to buy bread.
Exactly. Clutter causes confusion, and confusion inevitably leads to abandonment. People just close the app, delete it from their phone, and go back to a messy notebook or a literal shoebox of receipts.
It is like buying a multi-tool that has 400 different attachments. Sure, it can technically defuse a bomb and repair a satellite, but it weighs 50 pounds.
Right. You can't even lift the thing to use the knife blade to open a cardboard box.
Exactly. You just need a perfectly honed, simple chef's knife. So how does this micro-retail template we're talking about actually fix the UI problem?
Well, the very first step is a radical shift in terminology. The system deliberately moves away from all those legacy British and Commonwealth gap terms.
Because those old terms are highly formal and, frankly, just archaic.
They really are. Let's take the concept of people owing you money. In traditional accounting, that goes into a massive ledger called debtor's control.
Debtor's control. I mean, it sounds incredibly punitive, like something straight out of a Charles Dickens novel. You expect to be sent to a debtor's workhouse or something.
It really does. It creates an actual psychological barrier for the user. It does not sound like a friendly neighborhood transaction where you let someone take a cold drink on credit.
No, it sounds like you're calling in a collection agency.
So the simplified chart of accounts just completely strips that away. Instead of debtor's control, it uses plain, descriptive English.
So what does it call it instead?
You might see a ledger simply called customer book, or even something as casual as outstanding side hustle monies.
Oh, I like customer book. That makes sense to my brain.
Right. And instead of the terrifying term creditor's control, it just uses supplier credit.
That's so much better. Supplier credit. It actually tells you what it is.
Exactly. And the brilliant part is that the structural math, the rigorous double-entry logic operating behind the scenes, remains entirely intact. It is completely compliant with accounting standards.
So you aren't breaking any rules.
Not at all. The underlying math is solid, but the user-facing labels have been modernized for everyday accessibility.
So if you, the listener, have ever tried to set up a budget and felt a spike in your blood pressure just looking at the category names, take a deep breath. You aren't crazy.
No, you were just trying to read a highly technical foreign language without a dictionary.
But we are going to hand you the decoder ring today. Let's look at how this system actually organizes your financial life into manageable, logical blocks, because there is a core numeric matrix at play here, right?
Yes, a flow that guides the money. It is built around 6 primary buckets.
6 buckets, okay.
This is the architectural foundation. You don't need to memorize thousands of individual account codes. You just need to understand the directional flow of these 6 blocks.
Because it follows the natural life cycle of a business.
Right. Exactly. It maps out exactly how money moves in the real world.
Let's walk through that life cycle then. For you listening, grab a mental pen. The foundation starts with the 5,000s block. What are the 1,000s?
The 1,000s are your assets. Simply put, this is the stuff you own that holds value.
So, like the money in my bank.
Yes, your bank accounts, the physical cash sitting in your till, your savings accounts, the inventory on your shelves, and your business equipment. All of that lives in the 1,000s.
Okay, that's easy enough. 1,000s are things I own. What's next?
Then you have the 2,000s block, which encompasses your liabilities. This is the exact inverse. It's what you owe to other people or institutions.
No debts.
Exactly. It's your credit card debt, your vehicle finance, unsecured bank loans, and that supplier credit we mentioned earlier. The 2,000s are your burdens.
Right, the stuff weighing me down.
Yeah.
And rounding out the foundational trio, we have the 3,000s block, which is capital and equity.
Yes, the 3,000s. This represents your personal net worth within the system. It tracks your initial startup investments and the historical retained earnings of your hustle.
So if I put 10,000 Rand of my own savings into my spaza shop to buy the first round of stock, that goes in the 3,000s.
Precisely. Now, those first 3 blocks, the 1,000s, 2,000s, and 3,000s, they make up what's called your balance sheet.
Right. the big picture snapshot.
Exactly. They are the snapshot of your total wealth and total debt at any given second. They don't measure daily activity, they measure the accumulated reality of your financial existence.
But to track the daily activity, the actual day-to-day hustle, we move into the operational blocks, the engine room of the business, so to speak.
Yes, and that engine starts with the 4000s block, income.
The fun part, the money flowing in.
The very fun part, this is your primary salary, the wages from a part-time job, or the cash handed over the counter at your micro retail shop. Any revenue generated is a 4000.
Got it. And directly tied to that is the 5,000s block, right? Cost of sales.
Yes, cost of sales. This is a crucial concept for anyone selling physical goods. If you make an income in the 4000s by selling a cold drink, the 5000s block tracks exactly what it cost you wholesale to buy that specific cold drink from the supplier.
Oh, I see. So it's the direct cost of generating that specific piece of revenue.
Exactly. You can't have a 4000 retail sale without a 5000 wholesale cost attached to the physical item.
That makes perfect sense. And finally, the last bucket, the 6,000s block.
The 6000s are your expenses. This is the money flowing out just to keep the operations running.
The overhead.
Exactly. Your rent, your electricity, your internet bill, the petrol in your delivery car, and even your household groceries. All the friction of daily life goes into the 6000s.
The brilliance of this 1,000 to 6,000 numerical flow is that it creates an immediate, intuitive mental map for you. Once you internalize that any money spent on general running costs is a 6,000 level number, you never have to agonize over where to file a utility bill again.
Right, you just know it's a 6000. But the system designers understood a critical flaw in human psychology, which is that we just fundamentally hate memorizing numbers.
I know I do. I can barely remember my own phone number sometimes.
Exactly. So this brings us to a feature that completely changes the data entry game. It's called alphanumeric mapping.
Alphanumeric mapping. Explain how this removes the friction for a busy user who doesn't want to memorize a chart.
Well, friction is the ultimate enemy of consistent bookkeeping. If every single time you buy stock you have to open a manual and look up a 4-digit code, you will literally stop doing your books by week 2.
100%. I'd give up on day 3.
Alphanumeric mapping bridges the gap between formal accounting and human memory. So let's say you run a spaza shop and you just bought a new commercial chest freezer to keep your drinks cold.
Okay.
The formal JAP-aligned account code for shop equipment might be 1200 sitting over in the asset block, but the software interface doesn't force you to memorize the number 1200.
Thank goodness.
Right. It allows you to simply type the word fridges or freezer into the search bar, and the system automatically maps your English word to the correct 1200 ledger in the background.
That is massive.
Oh.
It allows you to literally converse with the software in your own natural vocabulary while the software handles all the strict compliance requirements out of sight.
It creates a seamless dual-layer system, a conversational, easy front end for the human, and a mathematically rigorous back end for the taxman.
Which is the dream, honestly.
It is. And to keep that front end as fast and frictionless as possible, there is a golden rule in this micro-framework. And this is vital. Absolutely no unnecessary subledgers.
Okay, wait. I am going to push back on this a little bit because this actually sounds counterintuitive to me. If I am running a business, don't I want maximum detail? What exactly is a subledger and why are we banning them?
It's a fair question. In a massive corporate environment, detail is everything. If a corporation has, say, 10,000 clients buying on credit, they create a dedicated subledger for every single client.
So a separate file for everyone.
Yes. They track John Doe's exact balance separately from Jane Smith's exact balance, all within the main software architecture.
Okay, that makes sense for a big company.
But in a micro-business context, let's say you run a spaza shop, and you allow 5 trusted neighbors to take bread and milk on credit until payday on Friday.
Happens all the time.
Right. If you create a heavy, formal subledger for every individual neighbor inside your accounting app, your system becomes bloated, it gets slow, and it becomes incredibly tedious to reconcile.
But wait, if I lump all my neighborhood customers into one generic account, how do I know if the guy at house number 42 actually paid me for last week's bread? Doesn't generalizing it defeat the entire purpose of keeping the books?
It's a super common fear, but you have to separate financial accounting from operational tracking.
Okay, break that down for me. What's the difference?
Your accounting software's primary job is to tell you the total value of your assets and liabilities so you know the overall health of the business. You use one single generalized account, let's call it the customer's control account, to track the total aggregate amount owed to your shop.
So that the total balance is R500?
You know you have exactly R500 in outstanding assets, period. To track the operational detail, like who specifically owes you what portion of that R500, you just use a simple physical notebook under the counter or a basic spreadsheet on your phone.
Ah, I see. You keep the heavy transactional noise out of the core financial engine. You just put the summary in the software.
Exactly. You manage the messy micro details offline, and you only feed the summarized, clean financial truth into the software. This keeps the app lightning fast.
Which is so important if you're using older hardware.
Yes, it doesn't crash your basic laptop or freeze your entry-level smartphone. I mean, in the informal retail sector, speed is literal survival. If the app takes 30 seconds to load a list of subledgers while customers waiting to pay for a cold drink,
You're going to abandon the app. You'll just chuck the money in the till and forget to log it.
exactly. The no subledger rule guarantees that essential speed.
That distinction between financial value and operational tracking is a huge light bulb moment for me.
Yeah.
So we have the map. We understand the 1,000 to 6,000 flow, the plain English terminology, and the need for speed. Now, I want to stress test this.
Let's do it.
Let's dive into the Spaza Shop blueprint. Let's see how this structure handles the chaotic, fast-paced reality of high-turnover, fast-moving consumer goods, FMCG, and the modern digital economy.
The Staza shop really is the ultimate testing ground. It is a perfect microcosm of complex retail, but it's operating in a highly constrained environment.
So where do we start?
Let's look at the 1000s block first, the assets. The template creates a vital separation right away. Account 1010 is designated strictly as till cash.
So that's the literal paper and coins.
Yes,
Yeah.
this is the physical, tangible paper money and coins sitting in your cash drawer. But sitting right next to it in the ledger is account 1020, which is designated for mobile wallets and digital payments.
Why is it so critical to split those up? I mean, if I sell a loaf of bread, money is money, right?
Yeah.
Why not just dump it all into a single income bank ledger and call it a day?
Because the informal economy is undergoing a massive digital revolution right now. 10 years ago, a Spaza shop was practically 100% cash.
True.
Today, that same shop owner is using card machines like Yoko or iCoca. They're accepting mobile wallet transfers via Capitec Business or using SnapScan QR codes.
Right. Everyone pays with their phones now.
Exactly. And if you lump a digital card swipe in with your physical cash under one generic account, your reconciliation process at the end of the day will be an absolute nightmare.
Give me a scenario. How does that play out at the end of a long shift if you don't separate them?
Okay, let's say your single generic software account says you made R1000 in sales today. You close the shop, lock the security gates, and you count the physical cash in the till.
Okay, counting the cash.
And there is only R600 in the drawer. If you didn't separate your asset accounts, panic sets in immediately. You think you've been robbed, or that your cashier gave out incorrect change. You end up wasting an hour frantically recounting the coins.
That sounds incredibly stressful.
It is. But if you use the specific accounts we just talked about, you look at your dashboard and see. Account 1010, till cash, has R600. And account 1020, digital wallets, has R400.
And the panic vanishes.
The panic completely vanishes. The structural separation mirrors the physical reality of where your money actually lives.
It prevents you from chasing ghosts at midnight. I love that. You also have account 1050 for inventory, right? Like the physical bread, milk, and maize meal on the shelves.
Yeah.
And account 1200 for shop equipment, like your commercial fridges and security gates.
Yeah.
So that organizes all the stuff you own. But what about the revenue streams? The sources say the Spaza Shop blueprint insists on separating the types of income you generate in the 4000s block. Why is that?
This is a fantastic piece of built-in business intelligence. Account 4010 tracks general retail sales. This is the revenue from handing a physical object to a customer, the food, the drinks, the household supplies.
Okay, standard retail.
But there is a separate account, 4020, for digital value-added services, which we usually call VAS. This tracks the money you make selling digital airtime, prepaid electricity vouchers, or digital lottery tickets.
Again, I just have to ask, why the strict segregation? Does the tax man really care if the profit came from a loaf of bread or a gigabyte of mobile data?
The taxman doesn't care at all. But you must care if you want your business to survive.
Why?
Because the economics of selling physical bread and selling digital airtime are fundamentally wildly different. Think about it. Bread takes up physical shelf space in your shop. It attracts pests like mice. It goes stale and has to be thrown away, which results in shrinkage.
Right, and you need a massive delivery truck to physically navigate to your shop to drop it off.
Exactly. Now compare that to airtime. Airtime takes up zero physical space. It never expires, it doesn't attract rats, and it is replenished instantaneously over the internet. Furthermore, the profit margins are totally different. You might make a 20% markup on a loaf of bread, but only a 5% commission on an electricity voucher.
Ah, I see. So by segregating them into 40/10 and 40/20, you instantly see your real profit drivers.
You see the truth of your hustle.
You might look at your ledger at the end of the month and realize, man, I'm working myself to the bone carrying heavy sacks of maize meal every morning, but 70% of my actual net profit is coming from the little digital airtime machine sitting on the counter.
Which is a huge revelation. It allows you to make strategic decisions about where to invest your precious capital. Maybe you stop selling maize meal and buy a second digital terminal.
Exactly. And speaking of capital and inventory, we really have to talk about how the goods actually get into the shop. Supply chains in the micro-retail sector can be incredibly chaotic.
Oh, chaotic is putting it mildly.
Let's set the scene for the listener. Imagine the bakery truck pulls up to the Spaza shop at 7 a.m. to drop off 50 loaves of bread. But the shop owner hasn't had a busy morning yet. The physical till cash in account 1010 is completely empty.
Great, no float.
They literally cannot pay the driver cash on delivery, but they desperately need the bread to sell to the morning commuters. So they operate on a localized informal credit line with that driver. He drops the bread, and they promise to pay him later. How does this simplified accounting system handle that scenario without triggering a massive corporate-style procurement workflow?
This is where the 2000s Block Your Liabilities acts as a brilliant financial shock absorber for the business.
Okay, how so?
The template uses an account, usually 2010, designated as supplier credit or accounts payable. When the driver drops off the bread, the shop owner enters a quick transaction that does two things simultaneously in the background.
The double entry magic.
Exactly. First, it increases account 1050, which is inventory, because you now physically possess the bread. Second, it increases account 2010 supplier credit, because you now owe a debt to the bakery.
So the books stay perfectly balanced, even though no physical cash actually changed hands yet.
It flawlessly captures the reality of informal credit. You know exactly the value of the stock you are sitting on, and more importantly, you know exactly how much of tomorrow's cash needs to be ring-fenced to pay the bread guy when he returns.
It creates operational discipline without demanding a dedicated accounts department.
Precisely. And to complete the Spaza shop picture, we have to track the friction of doing business, the expenses over in the 6000s block.
Right, the overhead.
Two specific accounts are highlighted as absolutely critical for informal retail in South Africa. Electricity, which is 60/20, and transport or fuel, which is 60/50.
Why those two specifically?
Because in an environment where margins are razor thin, those two expenses are the silent killers of micro retail. Running 3 commercial chest freezers 24 hours a day in a hot climate draws a staggering amount of prepaid electricity.
That's true. The meters run down so fast.
And if the wholesaler's truck breaks down and they don't deliver, the shop owner has to pay for a mini bus taxi or put petrol in a bakkie to drive to a cash-and-carry warehouse to physically haul the stock back themselves.
Which eats directly into the profit.
Right.
So tracking those specific 6,000 level accounts really changes your entire pricing strategy. You realize that the true cost of a cold drink isn't just the R10 you paid the wholesaler.
Not at all.
It's the R10 plus a fraction of the petrol you burn driving it to the shop, plus a fraction of the electricity used to chill it in the fridge for 2 days.
Exactly. If you only track the wholesale cost and ignore the operational friction, you might price the drink at R12 thinking you are making a solid R2 profit. When in reality, after electricity and transport, you are literally losing money on every single sale.
Wow. That is the power of a logic-based chart of accounts. It elevates you from guessing to actually knowing.
It's survival data.
But, and this is huge, but all of this brilliant business logic, the inventory tracking, the supplier credit, the profit margins, it will completely disintegrate if we don't address the single biggest danger in microfinance.
Ah, yes, the intersection.
The dreaded intersection of business and personal life. The Spaza shop blueprint we just described is beautiful in isolation, but micro-businesses do not exist in a vacuum. They are run by human beings who have families to feed and rent to pay.
And this is where 90% of informal businesses just bleed out. In micro retail and home-based side hustles, business cash and personal cash mix with terrifying fluidity, the boundaries are almost non-existent for most people.
Let's use an analogy to illustrate just how dangerous this really is. Imagine this accounting system as an airlock between two spaceships that are docking in orbit.
Okay, Spaceship A and Spaceship B.
Exactly. Spaceship A is your business. It is your spaza shop, your weekend photography gig, your freelance coding hustle. Spaceship B is your personal household, your family, your domestic life.
Got it.
Now, you obviously need resources to flow between these two ships. The whole point of running Spaceship A is to provide resources and oxygen for Spaceship B. But if you just throw the doors open between the two ships while you are hurtling through the vacuum of space, what happens?
Disaster.
Complete disaster. All the oxygen, which represents your cash, gets violently sucked out into the void. You lose pressure, you lose your audit trail, and both ships crash and burn.
It is a really visceral image, but it is financially accurate down to the letter. Let's look at the daily reality of this. You make R500 selling goods in the shop today. That physical cash is sitting right there in the till.
Okay.
It is dinner time, and you need to feed your family. The easiest, most natural human reaction is to simply open the till, take out R200, and walk down the street to the supermarket to buy chicken and vegetables for your household.
I mean, it's your shop, it's your money, so it feels completely justified to do that.
It is justified. You own the business. But if you do not explicitly track that action in the software, your accounting system is going to interpret it as a catastrophic failure.
Wait, really? Why?
Because at the end of the week, the software looks at the sales logs, looks at the cash on hand, sees that R200 is just magically missing, and assumes the business is hemorrhaging money. The owner looks at the distorted profit report and panics.
They think they're failing.
They do. They might dramatically raise their prices, which drives customers away, or they might assume the business model is fundamentally broken and just shut it down entirely out of despair.
When in reality, the business was actually highly profitable. The margins were fantastic. You just ate the profits for dinner.
Exactly. You literally ate your equity. And this is why the chart of accounts introduces what I consider the ultimate safeguard. It uses a specific ledger located in the 3000s capital and equity block. It is known as the drawings account.
The drawings account.
Sometimes coded as G30010 or simply 3020 for owner personal drawings.
So the drawings account is the airlock.
Yes. The drawings account acts as an explicit, highly visible flag in the system. Every single time you pull that R200 out of the till to buy personal groceries, you log it to the drawings account.
So you're explaining it to the system.
You are legally and structurally telling the software, listen, this is not a business expense. I did not lose this money. The business did not fail. I am deliberately extracting equity out of the business layer to fund my personal lifestyle.
It tracks every single breath of oxygen you transfer safely from Spaceship A to Spaceship B. That's brilliant.
And this creates radical financial accountability for the owner. At the end of the month, you can look at your balance sheet and say, okay, the business generated R8,000 in pure profit, but my drawings account shows that I pulled R9,000 out of the till to pay for my personal life.
Oh.
Right. Suddenly, the mystery of the cash flow shortage is completely solved. The business isn't failing. Your domestic lifestyle is simply outstripping the business's capacity to fund it. It forces you to confront the reality of your personal burn rate.
Which perfectly transitions us to the next massive phase of this deep dive.
Yeah.
We have spent a lot of time analyzing Spaceship A, the business side of the equation. But how does the system bring that same rigorous logic to Spaceship B? Let's delve into the household economy. How do we track the chaotic reality of a family budget?
Well, the personal and household template is designed to deeply monitor domestic logistics and multi-source income. It completely acknowledges that a modern household rarely runs on a single, clean paycheck anymore.
Right, the gig economy has changed everything. People have 3 different jobs now.
They do. So on the income side, the 4000s block, the system gives a household the ability to track multiple streams seamlessly. You have one account, say G41010, dedicated strictly to your primary salary or wages from your formal 9-to-5 employer.
Okay, the stable income.
And right next to it, G42010, which captures your freelance, side hustle, or consulting revenue.
Isolating your stable employment earnings from your highly volatile side revenue is the first step in building a resilient household budget. You have to know what you can rely on.
Exactly. But the real heavy lifting, and honestly the most illuminating part of the system, happens over in the 6000s expenditure block. This is where we track the domestic burn rate.
The sources we're looking at outline a very granular approach to household running costs. You
Uh,
dedicate specific accounts for groceries and supermarket staples. You have an account specifically for tuition and school fees, another one just for educational supplies like textbooks and school uniforms.
Gets very detailed.
Now, I want to play devil's advocate here for a second because this brings up a major point of friction for a lot of people trying to learn accounting.
Go ahead. Fire away.
Under South African tax law, standard domestic consumer spending is entirely non-deductible. I cannot deduct my family grocery bill from my income tax. I cannot deduct my kids' school uniforms. SARS literally does not care how much I spend on peanut butter.
They really don't.
So if these expenses offer absolutely no tax benefit, why on earth should a user go through the grueling, annoying effort of tracking every single supermarket receipt and assigning it to a specific 6,000 level ledger? Isn't that just creating busy work?
That is a brilliant question, and it hits on a fundamental misunderstanding of why we keep records in the first place. People assume accounting is only for the tax man.
Right, to keep you out of jail.
But non-deductible expenses are actually the most important numbers for your own personal survival. You do not track groceries for SARS. You track groceries for you.
Explain the psychology behind that. Why is it so important for me?
It all comes down to liquidity monitoring and baseline survival. You cannot make a single strategic decision about your life or your business if you do not know your absolute minimum domestic burn rate.
The bare minimum to survive.
Exactly. If you don't know exactly what percentage of your core salary is eaten up just by keeping your kids fed and educated, you are flying totally blind. By rigorously segregating your non-deductible domestic expenses, you establish a concrete baseline.
It's the difference between generalized anxiety and actionable data. I think about parents lying awake at 2 a.m. You know the feeling. You're staring at the ceiling, your heart is racing, and you're wondering, can we actually afford to send our daughter on that school trip next term? Or are we going to default on the car payment?
It's terrifying.
If your finances are a mess in a shoebox, you have to guess. And guessing breeds terror.
But if you use this system, the terror just evaporates. The data is instantly available. You look at your ledger. You see the historical trend in your school fee account over the last 6 months.
So you know exactly what to expect.
Yes, and you cross-reference that with the dedicated primary savings account, which the system highlights to track your interest-exempt cash reserves. Within 30 seconds, you know exactly if the liquidity is there. You gain total, unshakable confidence in your net worth.
So tracking non-deductibles is about taking control of your own anxiety. I love that. But there is a secondary, highly practical reason to track these domestic costs too, isn't there? Especially regarding the modern shift toward remote work.
Oh, absolutely. Tracking domestic costs rigorously is the only way to rapidly isolate claimable pro rata allocations.
What does that mean in plain English?
Let's say you operate a SARS-compliant home office. You are legally allowed to claim a percentage of your overall home running costs against your taxes, usually based on the square meterage of your office space relative to the whole house.
But you can't claim that percentage if you don't know what the total cost is.
Exactly. If you haven't been strictly tracking your household electricity, your home internet bill, and your total rent in their specific 6,000 series ledgers all year long, you have no foundational numbers to work with when tax season arrives.
You're just making up numbers.
And you end up scrambling, guessing, or worse, underclaiming deductions you are legally entitled to because you just don't have the data to back it up.
Which brings us to the ultimate payoff. We have talked about the psychological relief of a clean budget, the strategic power of knowing your margins, and the safety of the drawings airlock. But the crowning achievement of this logic-based chart of accounts is how it tackles what is universally considered the most stressful administrative burden of adult life: making peace with SARS.
Tax season.
Tax season, the time of year when millions of people realize that their shoebox of receipts is completely and utterly inadequate.
But the architecture of this micro-retail template natively aligns with the SARS eFiling system. It is built with professional compliance woven into its very DNA.
How does it actually turn tax season into a simple exercise, though? Give me the mechanics.
It achieves this by mirroring the exact structure of the SARS ITR-12. That's the income tax return for individuals.
Yeah.
The ledgers you have been using all year are conceptually mapped directly to the fields on the tax form. It removes the need for any translation.
Let's run through a practical simulation. I have my accounting software open on one screen and the SARS eFiling website open on the other. How do the puzzle pieces connect?
Okay, let's start with your primary income. You look at your ledger for salary and wages. The total balance sitting in that specific account at the end of the tax year conceptually maps directly to SARS code 3601, which is net pay, found on your IRP-5 certificate.
So if my employer's IRP-5 says my net pay was R300,000 and my internal ledger also says R300,000, I have instant verification.
Exactly. It is a built-in reconciliation check. You know immediately that your foundational data is solid.
What about the investment side? How does it handle that?
The system uses a specific ledger to track dividends and interest income. The year-end balance in this ledger ties natively to the third-party IT3B certificates you receive from your bank or your investment broker.
Oh, those documents the bank emails you every year.
Yes, and the beauty here is that by having a dedicated account, the software helps you isolate your local interest earned, which is vital for tracking against the standard SARS interest exemption thresholds.
Okay, that handles the money coming in. But what about the deductions? The holy grail of tax filing, the things that actually lower my tax liability. How does the system organize those?
The chart of accounts isolates deductible allowances into highly specific ledgers, ready to be plugged straight into the e-filing wizards. For example, there is a dedicated account for your health insurance and medical aid premiums.
Okay.
When you pull the total from this account, it directly drives the generation of the medical schemes fees, tax credit rebates on the SARS platform. You don't have to hunt for the number.
And for long-term planning, like retirement stuff.
You have an account specifically designated for retirement annuity or Regulation 28 pension fund contributions. The total in this ledger is what you use to populate the deductible tools under Section 11F of the Tax Act.
It's all just sitting right there.
Furthermore, if you are philanthropic, there is a specific ledger that logs payments made to registered public benefit organizations, or PBOs.
Ah, the Section 18A deductions. I know people struggle to track those.
They do. But by logging your charitable donations in this isolated account all year, you immediately know your total qualifying amount, bearing in mind that Section 18A deductions are capped at 10% of your taxable income.
So you don't have to sift through a year of bank statements trying to remember which payments were donations to an orphanage and which were just gifts to family members.
Exactly. The data is pre-sorted.
This sounds incredibly smooth. You literally just look at the totals in your software and key them into the matching fields on the website. But we have to address the nightmare scenario. This is what keeps people up at night in cold sweats.
The audit.
The audit. You submit your perfectly aligned ITR 12, you hit send, and a week later you get a notification from SARS. Your return has been selected for verification, or worse, a full-blown audit. If I am using this simplified micro-template, am I going to be left exposed?
This is where the initial discipline pays massive, massive dividends. If you are using a shoebox, an audit is a disaster. If you are using this chart of accounts, an audit is simply an administrative task.
I guess it's already organized?
Because every single transaction flowed into clean, logically structured, audit-ready categories throughout the year, you have total peace of mind. If SARS demands proof of your medical deductions, you don't panic. You simply open your software, navigate to your medical aid ledger, and export the transaction history. It is perfectly contained.
But audits can get more aggressive, right? Especially if your side hustle starts generating serious revenue. What if SARS demands a comprehensive overview of your entire financial life?
For high net worth individuals or for provisional taxpayers, which is a status you might trigger if your freelance business scales up, SARS frequently requests a statement of assets and liabilities.
Right.
This is essentially a personal balance sheet. This absolutely terrifies people who only track their daily spending and ignore their broader wealth.
But if you've been following the 1,000 to 6,000 flow we discussed earlier.
Exactly. Your statement of assets and liabilities is already built because you have been using the 1,000s block to track your bank accounts, your physical inventory, and your fixed property.
Yes, and the 2,000s block to track the credit cards and the mortgage.
The snapshot is constantly updated. You literally click a button to generate a balance sheet report, and you hand it directly to the auditor.
This level of structured data isn't just a defensive shield against the taxman, though. It is actually a powerful offensive weapon for growth. Let's pivot back to Spaceship A, the spaza shop or the side hustle. Say your business is doing incredibly well. You want to expand. You want to buy a second location or upgrade your equipment. You need capital. You walk into a bank to apply for a commercial business loan.
And the loan officer looks at you and says, prove that your business is viable. You cannot walk into a major financial institution and say, "Trust me, I sell a lot of bread. Look at this spiral notebook."
They will laugh you out of the building.
They absolutely will. A bank demands formalized financial reporting. And with this accounting architecture, generating a professional, JAP logical income statement is a one-click process.
How does the software calculate it?
The software automatically aggregates your 4,000s block, your total income. It subtracts your 5,000s block, your cost of sales, to give the bank your gross profit margin. Then it subtracts your 6,000s block, your operating expenses, to reveal your net accounting profit.
So you slide a cleanly formatted, mathematically rigorous income statement across the desk. Your credibility as a micro-business owner skyrockets instantly. The bank stops seeing you as a risky, informal trader and starts treating you as a structured commercial entity. That is incredibly empowering.
It bridges the gap between the informal economy and formal financial institutions. It gives you legitimacy.
But speaking of formal institutions and compliance, we have to tackle the elephant in the room. The three letters that strike absolute terror into the hearts of small business owners in South Africa. VAT.
Value-added tax.
Value-added tax. It is a highly complex, heavily audited tax system. How does a beginner navigate this, and how does this simplified chart of accounts keep them from drowning in VAT complexities on day one?
The approach to VAT in this micro-framework is brilliant because it is based on aggressive simplification and deferred complexity. Let's establish the absolute baseline first. If you are operating a purely personal household spaceship, VAT is completely irrelevant from an accounting perspective.
Wait, I need to stop you there. What do you mean irrelevant?
Yeah.
I look at my supermarket slip every week, and I am clearly paying 15% VAT on my household groceries, my cleaning supplies, my toilet paper. I am definitely paying it.
You are paying it, yes. But in the eyes of the tax system, you are the final end consumer. The buck stops with you. You pay the tax to the supermarket, but you do not collect VAT from anyone else. You do not track it on behalf of the government, and you cannot claim it back.
Oh, I get it. So I can't do anything with it anyway.
Therefore, from a bookkeeping standpoint, separating it out in your software is a massive waste of your time.
So how do I log that supermarket receipt in my software then? Do I just ignore the VAT line?
Yes. If your household buys groceries for R$1,150 and that total includes R$150 of VAT, you completely ignore the split. You simply take the gross total of R$1,150 and post it directly to your groceries ledger in the 6,000s block. You treat the tax as an invisible part of the total cost. It keeps your personal books incredibly clean and lightweight.
Okay, that makes perfect sense for the household. Keep it simple. But what about the side hustle? What about the spaza shop owner buying stock wholesale and selling it retail? Do they need to start tracking VAT the moment they open their doors?
This is where understanding the statutory thresholds is vital. In South Africa, you are only legally compelled to register for VAT, charge it on your sales, and track it in your books when your gross sales, your total turnover, exceeds R$2.3 million over a consecutive 12-month period.
R$2.3 million. Let's put that in perspective for a second. For a spaza shop or a part-time freelance graphic designer, hitting R$2.3 million in pure sales in a single year is a massive, massive volume.
It's huge. The vast majority of micro-businesses are nowhere near that threshold. Now, the law does allow for voluntary registration if your turnover hits R$150,000. But, and I cannot stress this enough, unless your specific business model relies heavily on claiming massive amounts of input VA back from zero-rated suppliers, voluntary registration is usually a devastating trap for a micro-entrepreneur.
Why is it a trap? It sounds like you might get money back.
Because it introduces a massive administrative burden. It requires meticulous bi-monthly filings, and it exposes you to intense, constant SARS scrutiny. If you mess up a VAT return, the penalties are severe.
So the practical operational advice for someone setting up their books today is what? Avoid it at all costs.
If your spaza shop or side hustle brings in less than the R$2.3 million threshold, you operate outside the VAT system entirely. You do not charge VAT to your customers, and you cannot claim back the VAT you pay to your wholesalers. Therefore, the absolute best practice when configuring your software is to set the default templates to tax-exempt or no VAT.
You deliberately hide the complexity from yourself.
Yes, you keep VAT completely out of your chart of accounts. Your expenses are posted gross, inclusive of whatever tax you paid the supplier, and your income is posted gross.
Give me an example of the income side.
If you sell a cold drink for R$15, the full R$15 goes directly into your general retail sales account. You don't have to become a tax expert on day one. You focus on growing your business, not administering government tax policies for free.
I love that. Focus on the hustle, not the bureaucracy. But let's indulge a best-case scenario. Let's say the hustle pays off spectacularly. Your freelance agency goes viral, or you franchise your spaza shop, and suddenly you blow past that R2.3 million threshold. You are legally required to register.
It happens.
Do you ever throw this entire simplified accounting system in the trash and migrate to a terrifying corporate software package? Because that would be awful.
Not at all. And this highlights the architectural genius of the system. It is fully modular. It scales with your success. When you breach the threshold, you don't rebuild the house. You just unlock a new room.
What do you mean by unlock a new room?
You simply activate what the system calls a tax module plugin.
And what does flipping that switch actually do to my daily workflow? Does everything change?
No, it just unhides a series of highly specific compliance ledgers that were sitting dormant in the background all along. Suddenly, accounts like SARS VAT output and SARS VAT input become active within your liabilities and assets blocks.
Oh, I see.
From that point forward, the software will prompt you to split the tax out of your daily transactions. But the core foundation, your 1,000 to 6,000 flow, your plain English terminology, your drawings, airlocks, stays exactly the same. You just appended the necessary compliance layer at the exact moment it became legally required.
It doesn't crush you with the weight of corporate complexity when you are small and fragile, but it possesses the structural integrity to handle that complexity when you grow big enough to need it.
It is the perfect pragmatic middle ground. It rescues you from the chaos of the shoebox, but protects you from the oppressive bureaucracy of a multinational GAAP framework.
Wow. We have truly covered an immense amount of ground today. We have taken the intimidating world of formal accounting and decoded it for the everyday hustler.
We really unpacked it all.
We did. We've mapped out exactly how a streamlined, logic-based chart of accounts can rescue your finances. We have looked at the granular reality of a spaza shop, how separating physical till cash from mobile wallets prevents reconciliation panic, and how tracking supplier credit allows a business to survive the daily chaos of the supply chain.
We have also explored the vital necessity of the drawings account. We established it as the crucial airlock that protects your personal household cash from your business cash, ensuring you don't accidentally consume your startup capital under the guise of living expenses.
And we shattered the myth that non-deductible expenses aren't worth tracking. We proved that knowing your domestic burn rate is the key to psychological peace and strategic power.
Absolutely.
And we saw how organizing those expenses natively aligns your ledgers with the SARS ITR-12, transforming a stressful tax season into a calm, data-driven exercise, all while keeping VAT complexities locked away until the exact moment your growth demands them.
It gives the micro-entrepreneur, the freelancer, and the head of the household the exact tools they need to achieve deep financial clarity without requiring a university degree in accounting.
As we wrap up this massive deep dive into the source material, I want to leave you, the listener, with one final, slightly provocative thought to mull over. We've spent the last hour meticulously discussing the mechanics of this system, the 1,000 to 6,000 flow, the plain English ledgers, the tax mapping, the operational thresholds. But what about the profound psychological impact of adopting this framework?
It changes how you see money.
It really does. Think about this. What if managing your personal household finances with the strict, unforgiving logic of a commercial micro-business fundamentally alters your emotional relationship with spending? In this system, you are no longer allowed to just spend money. You are forced to structurally separate your active turnover, the hard-won revenue you generated, from your domestic consumption.
It creates a powerful boundary.
Once you set this up, you will eventually look at a screen where your monthly grocery bill, your electricity costs, and your entertainment spending are sitting on a clean, digitized ledger directly beneath the sweat equity and revenue of your side hustle. The illusion of an endless, vague bank balance completely disappears. It is replaced by stark, undeniable data.
You can't unsee it once it's there.
When you see the numbers side by side, every single purchase, whether it is a new textbook, a tank of petrol, or a casual takeaway dinner, stops being a mindless swipe of a debit card. It becomes a strategic business decision. You begin to view your own household as an enterprise that requires careful capital allocation. How would seeing your personal life as a highly structured, audit-ready operation change the way you interact with your money tomorrow morning? Will that messy shoebox of fading receipts finally become a relic of the past, replaced by the calm confidence of a perfectly balanced ledger? Thank you for joining us on this deep dive. We will catch you next time.